Hello everyone, my name is Vinay Joseph and I head investment products and strategy at Standard Chartered Bank, India. And welcome to our first episode of our video podcast series. Today, I'm joined by a very special guest, Mr. Manpreet Singh Gill, Chief Investment Officer for Africa, Middle East and Europe for Standard Chartered Bank. Hello Manpreet, welcome to the podcast.
Thanks so much, Vinay, for having me on today.
So let's get straight to it. We've been in a very volatile world. We have seen a new president, Mr. Trump, coming in, and we have seen geopolitical tensions. And now we are grappling with this entire new AI episode. How do you see markets with that?
Well, we're actually still fairly optimistic. And I think it's interesting that the list you ran through obviously gave us a nice list of things to worry about. But at the start of each year, there often always is a long list of things to worry about. But what's important is to really look through that and say, what are the long-term fundamentals really telling us? And in our view, the growth data is ultimately sending a more optimistic signal. And it's admittedly a more US-centric story. And that's where growth was strong already even before Trump's inauguration. But today, we still see, strong economic growth propelled by his policies as well. And we think that, of course, will sort of set the stage for financial markets, which will ultimately feed off that strong economic growth, translating into earnings for the equity market.
So Manpreet, we are in a very volatile environment. We have got a new president, Mr. Trump, and we keep talking about this Trump trifecta. What does it mean?
Well, Trump trifecta, I guess part of it is just coming from the view that there's never dull a moment with Trump around. But I think what we were really getting at is that, when you look at his policy pronouncements when he was trying to get elected, many of them seemingly seem to be in contradiction with each other, because we know Trump wants, full employment, more jobs for Americans. We know he wants to avoid, a high inflation, because that was a challenge in recent years. And we know from his prior, term that he does sort of take the stock market as one barometer of his success.
But if you're going to talk about in not wanting inflation, if you're going to have immigration curbs and tariffs also key part of your policy, it is inflationary, right?
Exactly. And I think that's exactly where we're coming from to say, well, if you want policies that are not inflationary, deregulation's great, tax cuts are great, but tariffs, immigration curbs, they can be a problem.
So is that still pitches an optimistic view in 2025 for a overall macro environment?
It is, and I think the key sits in the sequencing and the way in which policies are implemented. And a simple example of this is, what Scott Bessent once sort of gave an example through tariff policy, because you can put tariffs to maximum levels on day one, which is inflationary, and you leave the Fed in a difficult position of how to respond to that. The other way he proposed is that you can introduce tariffs in a trickle manner, small amount every month, but building up, say a couple of percent every month, and you increase it by another couple of percent next month, and you get to your target tariff level through that process. There's still some inflationary impact, but it's much better managed than going to maximum levels on day one. So that's really where our optimism comes from, that we think there are a mix of positive and negative policies, but on balance, we think the overall outcome should be a good one for the US economy and for financial markets.
So we are very optimistic as we go into 2025. Where are our overweights? And I'm guessing it should be growth assets, right?
Indeed, they are. And I think the number one and the obvious place to look is equity markets. So we're overweight global stocks relative to bonds and cash. And within that, speaking of Mr. Trump, of course, we're overweight the US, because that's exactly where you can find economic growth. Within Asia Pacific, of course, we are overweight Indian markets as well. And
when you talk of Indian markets, because we are back home, right, in India, and you've visited a lot of these markets right now, given our road shows which are going on. How is the sentiment for Indian markets, which investors have? Valuation has been a concern, but from a global CIO lens, how do you see Indian markets?
So it's interesting you mentioned the conversations, because when I was here 6 months ago, the number one thing to worry about was valuations. Today, that's not a concern, but the number one thing to be concerned about apparently is slowing growth and lackluster earnings. So it comes back to a point at the start of each year, you can always find a number of things to worry about. We take a slightly different view, which is that, look, the valuation concerns have definitely eased. And growth in our mind is just readjusted to a lower level. Let's not forget it's quite unusual to have the kind of strong double-digit trend growth without any corrections or pullbacks of the kind we've experienced in the last few years. So a bit of a correction of the kind we're witnessing today can actually be healthy. And in our view, as long as the growth fundamentals stay in place, which we believe they are, then these sort of pullbacks are a great opportunity to add exposure, which is why we're overweight.
So we've talked about equities. Any other places which we have overweight? And it's interesting in the report that you're overweight gold also, given the rally which you have seen.
Yes, and gold's an interesting one. But before that, we're overweight high yield bonds as well. And at least for global...
High yield would mean which segment?
Those would be riskier bonds. They tend to be more equity-like in nature. And the reason we like them is that they're more sensitive to growth, which is where we're optimistic, rather than high quality bonds where you tend to get into debate about RBI policy rates, Fed policy or inflation. So we're really trying to get exposure to growth. Gold, as you mentioned, yes, a very different sort of type of asset. And the reason we like it standalone is that we see a lot of demand from central banks from 2022 onwards that we think can continue. More interesting than that, of course, is that the driver is very different from what we've been discussing for stocks and bonds. Right? It's really the hedge properties, the fact that they can help you if there's a bit of temporary volatility of the kind we're experiencing today. And we think that, when added to a portfolio of stocks and bonds, can be a great diversifier.
So Manpreet, what are the 3 key takeaways if our investors have to take?
So I'd say first thing is to just stay optimistic. There's always a long list of things to worry about, but optimists, as I've often written about, tend to always win much more than pessimists, and that's truer in financial markets than anywhere else. I think second is have a healthy allocation to stocks, to equity markets, because we spoke about a lot of positivity about rooms for optimism. Equities is the way in financial market investors can really buy into that. And the third is stay diversified. A healthy amount of diversification is important, and we talked about gold or even some amount to bonds. So it's not just about stocks, but having that well-structured, well-diversified portfolio is what helps you set yourself up for success, through the volatility, through the cycles.
So Manpreet, very good takeaways. I especially like the last one of diversified portfolio because that's our core tenet when we do wealth management in India. Now, let's lighten it up. Are you ready for a rapid fire?
Oh, rapid fire. Always ready. That should be exciting.
There are 8 questions. These are the burning questions of which we have seen from our clients. So let's start. Is Donald Trump good news for India?
Good news, yes, ultimately.
DeepSeek, is it going to be good for AI mania?
Yes, because competition's good.
Okay. Have Indian markets bottomed out?
Nobody knows.
That's a very safe answer.
We think investors shouldn't be in the business of timing market bottoms. If there's value, we'd be buying.
Okay, that's a long answer. Is it the time to invest in markets?
Yes.
For any class of investors, is it lump sum or SIP?
Very personal question. Both very good technical strategies, but it depends on the goal.
Okay, let's quicken it up. Last 3 questions. Are we looking at a near-term recession?
No.
Will equities bounce back?
We think yes.
What's the trump card?
Investors always have the trump card in terms of when to actually be able to hit that buy button.
Well, that's the rapid fire. I'm sure our investors would be very enriched by these conversations. So Manpreet, 60 seconds on the clock. You have to summarize our global market outlook.
Oh wow, 60 seconds. All right. Okay, here goes. I suppose we're starting 2025 with a lot of optimism on economic growth, more so led by the US than other regions. And that's, of course, driving our preference for equity markets. We're overweight equities relative to cash and bonds globally. But within that, we're overweight the US amongst major regions because that's where we see the economic growth. But it's not just about equities. We also think, like high yield bonds. That's, as a bond investor, one way to get more exposure to growth rather than interest rates and inflation. And we're overweight gold. Now, gold, of course, because it has its own standalone drivers of central banks, creating a lot of demand when supply is limited. But it's also a very different source of demand to that for stocks and bonds. So we like the diversification value. Finally, if we had things to worry about, we'd watch inflation, we'd watch the order of Trump's policy implementation, and we'd watch economic growth in China, but not beyond that.
Right on time. Thank you, Manpreet, for joining this first episode of our video podcast series. If you enjoyed this episode, stay tuned for the next episode with more interviews with industry veterans.